We're here in Times Square having a midday market conversation with Nick Colas of Convergex. It's so good to see you again, Nick.
Great to be here.
Nice to take a break from the office and
really is.
think
Beautiful
about
day.
stuff. It is gorgeous out here. And sometimes it's good to kind of put what we've seen in perspective and look forward. So we're ending half of the year. Quarter wraps up today. We've had a lot of Brexit drama, obviously, since last week. When you look ahead to the third and fourth quarter, what are your expectations for the market?
Well, it looks like it's going to be a lot about what just happened in the past month, but in a couple of different ways. What did we learn this year so far? We learned that interest rates probably aren't going higher, they're probably going lower. Beginning of the year, there was all this expectation for rate increases. Now we're seeing a lot of rate declines. And what drove it? Politics. Come the third quarter, we're facing the US presidential election, all the uncertainty related to that, and we still have to deal with all the economic factors related to Brexit. So it's going to be a very tough second half, probably still modest gains, but a lot more volatility than we've seen, and we just got a taste of it this month. There's a lot more to come.
I want to ask you, when you say lower interest rates, is that the market driving rates lower, or is that the Fed being on hold?
It's a combination of both. The market takes its cues from the Fed. Whatever the Fed says the economy is doing, the market will take with a grain of salt, but largely look at. What the Fed has done in the past month is kind of give up on the notion of a rate cycle, really call the market or the economy more stagnated than it thought. And now we've got the Brexit uncertainty, so you've got the ECB and the Bank of England in play talking about more sluggish economy. So it's a combination of the market trying to discount those things and central banks saying it themselves.
Why have we seen the market bounce back from the early Brexit worries just in the last couple of sessions? Because that's confounded some people, actually.
Yeah, it's been quite dramatic because a couple of days ago it looked very tough, and now we seem to be bouncing back quite nicely even today. It comes down to two things. The first is the markets realize that Brexit's going to take years. It isn't a next month or even next couple of quarter phenomena. So for the moment, not a lot of headlines. The second thing is this rate discussion. And if the European economy is going to see more uncertainty, then the market rightly expects the ECB to keep rates low, maybe even cut them further, and also expects the Fed not to raise rates. Chances of a rate increase now through February of next year, according to the Fed Funds Futures market, less than 20%.
What about our own economy? Do you think we are going to get impacted from what's happening in Europe, and is that another reason why the Fed might be on hold? Will we see, for instance, a repeat of that May jobs report?
Yeah, it's exactly what markets are focused on right now, because we've had some reasonably good economic news, even with that jobs number, but the problem is the strong dollar. All this turmoil around the world is making people flow their money back into dollars, safest currency on the planet right now. That strengthens the dollar, and it makes it tougher for big companies to make money overseas. So we're going to have to see what effect that plays out in the jobs market and in the stock market, because we're going to have to take down earnings expectations as a result.
So typically we see small companies do better with a strong dollar because they're not worried about all that international business. They're just not in it. They don't have the currency issues, but we haven't really seen that. So that's been a little odd too. I mean, can small caps show some more leadership in the second half?
One would think they should for exactly those points. The US economy is doing better than the rest of the world, and they don't worry about the dollar. However, small cap stocks tend to be riskier. And in an environment where investors are taking a little bit less risk, maybe pulling in their horns a little bit, it's going to be tough to convince them to allocate capital to small cap names where they're going to see a little more volatility.
So where might people invest in the stock market? I mean, we're going to close out the quarter with some typical things, right? Utilities, pharma doing well, defensive names. Will that defensive posture, will that be the leadership in the second half?
It sure does feel like it, but when the stock market has a good first half, when it's up on the first half, it tends to do pretty well in the back half of the year. Going back to the 1950s, 80% of the time when the market closes the first half up, it'll close the second half up as well. If investors do start to feel more confident, then technology is one place to look, because it tends to do better than the market when the market's rising, and it has more growth in a very stagnant growth global environment.
I always like people to define technology because that's a big sector. It can mean a lot of things. Do you mean kind of the old school tech names, the Intels, the Microsofts, or do you mean Google and Facebook, or do you mean the people that make switches, Cisco?
Yeah, the short answer is all of the above.
Okay.
It is the technology part of the S&P 500 that includes all those names. It starts with Apple, goes through Google, Facebook. The index is concentrated in bigger cap names, but it's a very robust list.
What else potentially might do well? I want to ask you about banks, because we've seen huge volatility in banks. Now, if rates aren't going to rise, that would tell me that banks probably are not the place that most people want to be in.
Yeah, you put your finger on it. That's exactly right. I think most of the market would love to love the banks. They've underperformed for a long period of time, and they haven't done particularly well even this year. We just had some good stress tests come out, which should give people some confidence, but with that rate cycle, very tough to like that group.
The great thing about being live on Periscope is that people write in questions, and somebody actually just asked about Twilio. That was the IPO, kind of a darling, because we hadn't seen anything like that all year. What do you think about that stock? What do you think about the IPO environment now for the second half?
So it's a great question, very important point. Investors have been looking for that IPO window to reopen, because we all know there's a ton of great tech names that are private, many of which investors would love to have a little piece of. Hasn't really happened this year. The fact that the IPO window is opening up again is very promising, and it says that investors should be able to get a shot at some of these names we read about but can invest in, and it's also good for the market as a whole. It shows some investor enthusiasm, both in technology and in equities generally. We haven't had a lot of that, so it's good news all around.
Although I wonder if we get more volatility, if we might just see that market close up again, because that's what happened in the first half. We went into the first part of the year with some uncertainty, so IPOs dried up.
Yep.
And if the uncertainty comes back in a big way, they might dry up again potentially?
The IPO cycle is funny because it relies on market sentiment, but also the quality of the companies coming through and how they do in the first 1 to 6 months after they come out of the gate. The fact that we're getting IPOs performing better gives investors confidence that they can take down those incremental new IPOs, hoping the quality is better, because remember, the IPOs we saw in the back half of last year did not do so well in the first quarter of this year. That's what really soured investors.
We also have a question, Nick, about euro versus dollar. Obviously, we've seen the dollar strengthen in a very big way. What are your thoughts on that currency?
Yeah, euro's going to be under pressure for a while, both because the Eurozone economies haven't really grown very much. The ECB is now beginning to talk about perhaps even taking rates a little bit lower to try to spur that economy. And you have all the uncertainty, not directly related to Brexit, but what Brexit means for other countries like Spain, Italy, even France, that are facing elections in the next 12 to 18 months. How much does this leave the Eurozone conversation really inform those elections? So politically, it's a tough currency to like as well.
Well, then we also get into this whole negative rate issue. I mean, you're talking about taking rates lower by the ECB. I mean, then what happens? Then you have, let's say, another country decides, let's rethink what we're doing in the EU. Then you have more volatility. Then what else do you do with rates? I mean, you can't keep going lower and lower. We just don't know how to get out of this thing.
That's very true. And you've heard that conversation really pick up in the last couple of months. As more and more of the rate cycle turned negative in Europe. You see negative German rates, negative Japanese rates in Asia, and they're getting more and more negative. So it's definitely another conversation to watch. It's too early to throw in the towel and say it'll never work, but it is getting worrisome that it's not working better.
I'm very impressed with our viewers, very smart questions. They've all been great so far, including this one, gold in the short term, typical safe haven. Do you play it?
Wow, gold's had such a good run this year. The gold ETFs right now, GLD and IAU, that really dominate the gold ETF space, they've received over $17 billion of fresh money this year. If you aggregated those holdings, those two funds would collectively own more than all but 7 countries on the planet. So gold's been a very popular play. It is a good safe haven play. I do like gold longer term, but I'm always reluctant to buy new highs. And so I'd say wait for things to settle down and look at it again in a couple of weeks and see if the volatility has been reduced. But longer term, absolutely a good play.
Where would you say stock market valuation is right now, especially in light of the concerns you raised, potentially about corporate earnings going forward with that strong dollar? Are we fairly valued, overvalued in the market, undervalued?
By any objective historical measure, we are overvalued, and not by a little. The other side of that coin is interest rates. We've never seen Treasury yields 1 to 1.5%, and that's an important factor in valuation. So you don't want to walk away from equities because they're expensive, because rates do support it. But it is uncomfortable. It does cap long-term gains. You might not want to expect more than 3 to 5% returns for stocks until valuations can catch up with the reality of wherever earnings are.
And do you mean for the entire year, for the rest of this year, or?
Any rolling 12-month basis for several years to come.
Wow.
You know, historically when valuations are this high, you can still get positive returns, but they're not the 10, 15, 20% returns that you've seen historically.
When we started talking early on, you mentioned that this is what I love about being right here in Broadway, Times Square. Jesus Christ for President of the world. So you meet all people. I'm not going to have you ask about this, but I am going to ask you about the presidential elections because we have another question on that. Donald Trump, what does the Trump candidacy potentially mean for the stock market if we see Trump win the election, if we see lose? Does anybody fully know what it means for the stock market depending on who's going to the White House?
You know, if you'd asked that question a week ago before the Brexit vote, I think the answer for most investors would be a Trump candidacy has very little chance of actually happening. He has very low chances of becoming president, and so we shouldn't worry about it. The polls say that, the gambling lines say that, all the predictors investors looked at. Now we've got to rethink that whole thing. And so even if you don't think he's going to become president, you do have to think about what if the polls are wrong. And so it is going to be a much more important topic. The bottom line is it would create a lot of volatility because he's not been a politician before. We don't have a sense of what he really wants to accomplish or can accomplish. And so it would create a lot more volatility and turmoil near term until we figure that out.
And of course, we can't figure that out now, but we know that you can tell us which sectors look overvalued right now.
Overvalued right now, I'll tell you, from the basis that the whole market feels overvalued, I think you'd have to look at utilities having had such a strong move because rates had moved down so quickly and unexpectedly that's an area to be cautious with. If you are looking for yield, it's a fine sector. I'm not calling for a big pullback, but if you're putting fresh money to work, I'd say be a little more aggressive. Look at technology that hasn't performed all that well. Look at industrials, even though the strong dollar is going to hurt them, haven't performed all that well. And I'd look at healthcare, very nice defensive group. You're going to have some volatility through the election cycle because it is a popular political punching bag. Another area to look at that hasn't had the same kind of big moves that, say, energy or utilities have had.
Are you worried that we'll see just market inflows weaken a little bit in the second half?
Absolutely. The volatility doesn't tend to pull a lot of money into whatever market it's exhibited. So I do think the only area we've seen positive money flows year to date have been U.S. equities, and that was just in the past month. You've seen money outflows from emerging markets, from developed Europe, from developed Asia. That's probably not going to stop. So the U.S. market has seen some benefit. We'll still see a little bit more, but it's going to be a very tough second half to encourage a lot of incremental investment.
Although I wonder if the U.S. market is kind of like the good house in a bad neighborhood. If you look at some of these other overseas markets, maybe you can argue for some emerging markets, but certainly we've seen issues in EM, but I can understand why people would shy away from Europe. But could that be the case, that even though our returns are low, the U.S. just looks like the best market?
Absolutely, because just one simple soundbite. Every treasury still has a positive yield. We don't have the problem of negative yields here. We do have a little room to bring rates lower, and we have a much more normal looking market than a lot of parts of the world. And our currency right now is basically the currency, the fortress currency of the entire global system, which is a positive. So you can see people saying, I want to invest in US dollars, I'll buy some US bonds and some US stocks. So I do think that'll happen, but money flows are always very fickle. They can turn on a dime, particularly if you get some political instability here from wondering who's going to win the election.
But we've gone through elections before. I mean, this is obviously a more interesting one than others, but I feel like sometimes investors kind of work through those issues.
That's absolutely true. It is important to not invest with your heart when it comes to politics. You might love one candidate and hate another. That shouldn't really inform your investment process, because ultimately the great thing about America is no one person can screw it up.
That's right.
And that's a very powerful theme in investing. It doesn't honestly matter all that much who's in the White House relative to what markets do.
Nick, if you could think of an example of one company, even if it's a little bit, top heavy on the valuation, that's doing it right. Either a company that's cut costs or looked to new markets or managed itself internally. We have, for instance, a word of a big merger, Mondelez making a bid for Hershey. Those are the reports. What kind of company sticks out in your mind as like, hey, maybe if I don't have this stock now, I like what's going on and it's worth looking at?
That's very tough. We don't do a lot of single stock analysis, and unfortunately the narratives recently have been more companies that are doing it wrong than doing it right.
That's why I asked the question.
So it's nothing really comes top of mind. I think as an investor, you're always looking for a company that you feel has strong management, a strong position in its particular market, a competitive advantage that you can identify and really relate to. And then that's the kind of equity you want to own longer term. Valuations will be whatever they're going to be. But when you think about how Warren Buffett invests, he doesn't talk about valuation very often. He talks about competitive advantage and a strong management team. That's a pretty good playbook.
What do you make of these mergers, not just Mondelez, but also this Stars deal that we had? Will we see more M&A activity in the second half, or does that also fall victim to some of the other worries we talked about?
No, it's a great point. M&A is often an indicator about how confident CEOs are in their business. CEOs will know more about their business than any public market investor will. So the fact that they're willing to do M&A and acquisitions and kind of bet the farm a little bit on a big deal tells you they feel pretty good about their base business. No CEO wants to come out a quarter after a big acquisition and say, oh, we missed the quarter. So it is a positive sign for at least those sectors where you see M&A that things are pretty sound.
All right, so let me try to sum things up with you. Stock market gains the next 12 months, 3 to 5%.
Yep.
Volatility still to come. Fed is on hold, but the U.S. looks like the best game in town.
That is very well put.
All right, well, before we say goodbye, you and I are going to sail away, and that is the cue to go in close on this tie, because it's almost July 4th weekend. We need a holiday. The last time I talked to you, Nick, we were looking at your tie, which was fascinating. This has got sailboats, QE2. I mean,
yes,
that's perfect.
This is a tie that goes back to when the Fed was easing rates and buying a lot of bonds. Maybe we'll see it again.
We just might, and that we'll save for another lunchtime conversation. Nick Colas, thanks for spending lunch hour with us.
Thank you.